The next hour will cover the state of the voluntary carbon market, including the volatility and complexity that have made the headlines over recent years. And additionally, we'll discuss some of the challenges that businesses encounter when navigating the market and how carbon credits are an essential tool in working towards decarbonization targets. Although both voluntary and compliance markets are currently active, this webinar will focus on the voluntary market. And our goal today is to share some insights to help you make informed strategic decisions when navigating the market, whether or not you're experienced in here or have made several purchases before. I'm Tori Chen, an analyst on Carbon Better's climate services team, where we work with clients to support their sustainability journeys through environmental accounting, strategy consulting, and carbon offset sourcing. Before I hand it over to the panelists to introduce themselves, I'd like to call to your attention a few webinar features. On the bottom right-hand side of your screen, you should see a questions button and a chat button. If you have a question, please enter it with the questions feature and we'll answer them during the Q&A session at the end. And our chat will be moderated during the session by our team member, Chris, so feel free to engage in there as we go. This webinar is also being recorded and will be available for replay and sharing. And with that, let's turn it over to our first panelist, Dominic, for an introduction.
Hi, everybody. I'm Dominic Sung, Director of Business Development here for Carbon Better. And I help lead our voluntary carbon market efforts here. And as always, whether we're helping clients quantify their impacts, create comprehensive sustainability reports, or decarbonize through direct reductions and participating in the traded voluntary carbon markets, we strive to do so with transparency and traceability. Prior to Carbon Better, I spent almost 20 years in the energy trading industry, focused on hedging, risk management, derivatives, and energy-linked financing.
Thanks, Dominic. Our next panelist is Nicole. Could you introduce yourself?
Yeah, of course. Hi, all. I'm Nicole Sullivan. I'm Director of Climate Services for Carbon Better. I'm an environmental engineer by trade, and I have really spent my career in sustainability and carbon accounting, helping clients at every stage of their journey, from quantifying their impacts, disclosing their impacts through reporting and storytelling, all the way through to reducing their impacts, both through direct reductions and participation in the voluntary carbon market. And I'm excited for this discussion today.
Thanks, Nicole. Our third and final panelist today is David, joining us from Lancis. Could you introduce yourself, please?
Yeah, thanks for inviting me, Tori. David Moffett, I'm Managing Director at the Lancis Fund. We're an investment fund that's supported over 40 carbon offset projects in the US and Canada. We've been doing this since 2017. Our anchor investor is a Canadian pension fund. I started my career at the World Bank, managing environmental projects. I've also worked at the Nature Conservancy, acquiring land for conservation. And I began working in carbon markets in 2009 and have been active in them ever since.
Awesome. Thanks, David. Now let's get things started by getting some context about the current state of the market. Before we get started with our first question, I just want to call out that some of our slides will have QR codes that link to deeper dives on relevant topics, so please feel free to scan those if you're interested in learning more. And with that, Dominic, could you give us some context about the various players in the voluntary carbon market? It seems like market participants are ever evolving and new ones are spinning up rapidly. Can you break down the roles of some of the most common market participants, such as registries and project developers?
Yeah, I'd be happy to. I think that's a really good place for us to start and sort of set the table for the rest of the conversation. So I'll try to group some market participants together into cohesive groups to try to simplify how that works. But the first group of market participants that I would want to talk about are producers. And so these are those that actually generate credit issuances. And for the voluntary carbon market, I would lump together project developers and investors together. So more specifically, project developers and their partner investors like in Lancis, or off-takers that have chosen to invest in projects. And the reason I would lump them together is project developers generally don't have access to debt markets for capital. So you need really both the project developers and the investors working together in order to generate credit issuances. The next set of market participants that I would talk about are consumers, or the actual user and retirer of credits. So Again, in this market, producers, investors, and consumers are maybe more uniquely than other traded markets intertwined in a way that's much tighter because, again, the lack of debt financing capability for these projects, really the only way to access capital is via the buyer or end consumer. The next group of market participants I would talk about are traders. And so these are the folks that are looking to take positions in order to make profit from those positions without direct interest in the retirement of credit. So I think that's, again, the important part of that market participant group is that the lack of direct interest in the retirement of the credits. And so if we look at the general consumers who we've got as just as examples on the screen of the Apples, Disneys, Volkswagens, Googles, Microsoft, Shells of the world versus the traders and trading shops of Mercuria, Trafigura, Vitol, and the like, you can start to see the differences between those. The next group are intermediaries. Intermediaries like ourselves, Carbon Better, play a very critical role particularly in this voluntary carbon market that is unregulated because there's not published pricing, published transactions, indices, exchanges, or anything of the like to provide liquidity and transparency to what's happening in the market. And so intermediaries are facilitators of transactions that help participants enter into contracts, provide transparency on pricing, market information, manage the settlement and retirement of contracted credits, and generally are there to reduce risk in the marketplace. So some of the examples are, again, intermediaries like ourselves, Carbon Better, or brokers and agents like Evolution Markets, Carbone, Emerex, and some others that are listed there. Registries are another group of market participants that are the platforms and databases that track ownership, issuance, retirement, and the transfer of carbon credits, and they really play a critical role in maintaining the validity and transparency of carbon credits through documentation and verification, so that they also help avoid double counting and facilitate transactions in the carbon market that way. There are a number of registries available, and I think we would pretty clearly say that a public ledger and third-party verification are really a must for us for a registry to be high quality. And so some of the examples we've listed there, the American Carbon Registry, Climate Action Reserve, Vera, Gold Standard, those are 4 major registries that we've put out there. There are obviously many choices of registry, and so we've just listed a few of the examples. Third-party verifiers also play a major role as market participants. I mentioned them briefly when I talked about registries, but they're independent organizations whose role is to inspect a carbon credit generation project and verify whether it meets standards and protocols as intended for credit issuance. So really to independently verify that what has been laid out in project design documents is actually what's happening when a project is implemented. And ratings agencies, these are starting to take a much more interesting role in the marketplace as they start to develop and start to diligence more. But agencies like B0, Silvera, Calyx Global are really working to diligence projects and assign them a rating based on specified criteria. Now, granted, these criteria may be different between the different agencies, but they're really what they're attempting to do is create the ability to compare projects more uniformly in an apples to apples way than is currently available in a space where it's just really difficult to do so when projects are really unique, geographies are different, and things in a voluntary world are a bit non-standard. So hopefully that gives a good overview of the market participants and all interacting together to make this voluntary carbon market work.
Yeah, thanks, Dominic, for that context. It's definitely really helpful and also helps tee up our next section, which is talking about the quality and integrity of credits, especially as there's so many different types of projects out there. It's kind of hard to tell what's a good credit, what should we be looking for when we're investing. So, Nicole, could you share some insights on what to keep an eye out for when searching for quality carbon credits?
Yeah, definitely. Perfect, thank you. So there's a number of core quality criteria or integrity criteria that we like to look for when assessing projects on behalf of our clients. So one of those criteria is the project additional. Would this project or would this carbon credit have existed business as usual with existing funding schemas, or is there an additional environmental benefit to the project that also wouldn't have been able to occur without that carbon financing? Next, we look at, is the math realistic and credible? Was there a credible baseline, performed according to like a scientifically rigorous protocol? Does the math make sense? And not only that, but is there robust measurement and verification? You'll hear the term MRV, so monitoring, reporting, verification, thrown around a lot in this space, and it's so critical path to understanding: is this a quality carbon credit? Is the project implemented as stated in the associated project documentation? Then we also look at permanence. How durable is that avoidance or removal of carbon? A next one that's hyper important is, especially from a carbon accounting perspective, is making sure there's no double counting. So is this credit on a public registry that when you retire the credit to actually offset your emissions, that credit is canceled out, and there's documentation and proof that credit was applied and no longer can be transacted again? And then lastly, another one we look at is co-benefits. So is the project doing more than just reducing or removing or avoiding a metric ton of carbon dioxide, but is it also creating some sort of social benefit or other environmental benefits such as biodiversity or water benefits? So these are just some general quality criteria to look for. There's also an integrity council for the voluntary carbon market, or the ICVCM, and they've released what's called the CCPs, or the core carbon principles. And this is something I think, participants in the market, both on the buy side and on the supply side, they're really looking for guidance and being able to point to something that says, this is what a quality credit is, and this is how we apply carbon credits. So something that is coming out of COP28 that we've been watching closely is the ICVCM, along with the different carbon registries, as well as reporting bodies such as CDP and target setting bodies such as SBTI. There is an effort going on currently to really kind of streamline the definition of what a quality carbon credit is, as well as how you apply carbon credits to your offsetting efforts.
Thanks, Nicole. So given this quality assessment criteria, David, what due diligence processes should businesses consider incorporating into their purchasing processes to minimize risk when choosing credits?
Yeah, thank you. I think building on what Nicole said, that it really depends on a number of factors related to your organization. And an important part of this is really how critical are those credits to your organization from, say, three perspectives: the financial perspective, your partners and your stakeholders, and your view around risk. And then I'd add in as well your capacity to undertake due diligence or willingness to engage others to do it for you. As an investment fund, Inlansis has a lot of experience in this space. We do a lot of due diligence. We do it before we invest capital into a project, and we're making those investments well before a project begins operations. So for us, we conduct site visits, we interview the management, we interview key suppliers, we do a lot of analysis ourselves. And it's across a range of criteria, spanning the developer, project operations, and economics. Carbon data management, which is critical because the data isn't managed well. It doesn't matter how good the project is, credits will not be issued. ESG regulations, and just the business environment for the particular operation. I'd say when we don't have internal expertise on a particular project type, restoration, forest restoration, reforestation, will generally hire third-party experts. That's what we do. I think for an organization that is looking to buy issued credits annually, rather than say make a 10-year investment, then I think the due diligence can be significantly reduced. I'd start by just buying credits from well-established registries like the ones that Dominic referenced. I'd also review all the documents available on the registry for a particular project, the project design document, the issuance history, any anomalies in that history, at least the verification report for the year, or as we call it, the vintage you're considering buying. And then a really thorough internet search on the developer, the top management, and the particular projects. I think that'd be a good place to start. And just circling back, I think it's a lot like any business purchase. If this is a major one for you from a dollars perspective, from a reputation, from a risk perspective, then I think you want to do more rather than less, and get good advice in doing that.
Thanks, David. So it seems like registries have come up a few times during this discussion of carbon credit quality. However, over the past year, there have been some concerning headlines. For example, Verra Carbon Standard has come under much scrutiny for the integrity of its carbon credits and verification methodologies. As a result, we are seeing other new and alternative registries emerge. Nicole, are there risks or quality concerns when buying credits issued on a new registry?
That's a great question. And, I'd kind of point back to both what myself and David were talking about in terms of quality criteria and risk assessment. And with any emerging registry, as well as really with any carbon credits or even new technologies or new protocols existing on or emerging on existing registries, it's really important to really consider quality, and that includes looking at, does this new or emerging registry, does it have third-party verification requirements? Does it have that public ledger showing you the transactions and the retirements? Are the documents surrounding their protocols, so those, the documentation that enables you to pursue carbon credits on that registry, are those protocols and methodologies public and available for review and public comment as they issue them? There's so many questions to ask and so much due diligence to consider, whether that's issuance history, as well as the types of credits, right? So there are a number of existing robust registries that we all kind of look to as those core registries globally and domestically here in the US. But some of those registries are limited to certain project types or certain, as we refer to them in the space, like certain technologies. So I think another important question to ask is, what gap is this new registry or emerging registry filling in terms of, is it bringing new project types to market that, didn't fit within one of the other existing registries? So I think really my answer is that there could be quality concerns, especially if significant documentation isn't provided and made public by that registry. So I think it's a matter of due diligence and comfort level, as well as, what are your goals and what are the project technologies being issued on that registry?
Thanks, Nicole. So with this understanding of carbon credit quality, let's now talk about the different types of credits on the market, specifically removals versus avoidance credits. And before we get to our first question in this section, we have another quick poll for our audience asking, do you have a preference for avoidance or removals credits? So it looks like we have some spread out answers, but the majority seem to be in the mix of both range. While we let you guys continue answering that, if you haven't had the chance yet, we'll move on to our first question. So as we are seeing increased urgency in scaling removals, particularly in the case of businesses that have set targets aligned with the Science-Based Targets Initiative or SBTI and will have to rely on removals credits for meeting their decarbonization targets. Dominic, are avoidance credits still acceptable tools for mitigating emissions?
Yeah, that's a really good question that has a lot of nuance to it. But the short answer is yes. Avoidance credits are still acceptable tools for mitigating emissions. I will qualify that statement with a few things here, though. What I would say is that when we're talking about avoidance versus removals, inherently when you say versus, you're almost pitting them against each other, and we need to be careful not to oversimplify that comparison or be so reductionist as to imply that removals inherently represent a higher quality credit than avoidance credits. It's not that simple. And co-benefits and attributes of avoidance projects and removals projects really need to be examined when you're looking at the different projects. And avoidance projects are really important, and the co-benefits are so huge that you just don't get with some of the more quantitative technology-based projects. And avoidance projects are critical to address the urgency based on the availability of projects as a whole. The SBTI guidance that is out there is ambiguous, intentionally so, about the use of carbon credits to offset emissions, though it is clear that it is possible to have a science-aligned target and still have a carbon strategy that utilizes credits. Leading up to COP28, or very recently, the VCMI has just issued new guidance in their updated claims code of practice for claims and usage of carbon credits. And in those claims, it allows for both avoidance and removals credits to be used under the guidance as beyond value chain mitigation. But they must be used by companies in addition to, not instead of, decarbonization as part of their net zero transitions. And as we really talk about, why avoidance credits are still acceptable and really necessary tools for mitigating emissions. I think if we talk about the scenario analysis of removals and avoidance credits and projected targets for what ends up being produced in the marketplace, in really high case scenarios that I've seen, and again, those scenarios are scenarios for which there isn't even enough capital on the table for them. You're talking about projections being 100 million tons of removals credits projected by 2050. And we really need to get to a gigaton of removals to get to a 1.5 degrees Celsius aligned scenario. So we need all the solutions, avoidance and removals, to get there. So all of that to say, yes, avoidance credits are still acceptable tools for mitigating emissions, and I think they're vital to addressing the urgent need to develop and fund projects and technology that we need to get us to our goals.
Thanks, Dominic. Definitely interesting to see how both of those work together. Another common topic that comes up when discussing removals versus avoidance credits are nature-based projects and why they are more complicated than just planting a tree or implementing improved forest management. So David, could you tell us about your experience with setting up projects and measuring impact and any challenges or obstacles that you face?
Yeah, happy to do that. I mean, our investment fund has supported multiple nature-based projects, including improved forest management projects, excuse me, and projects that at their heart are truly conservation projects. So the photo you see there is from our Wildlands Carbon Program. It launched with 12 properties in the Northeast, and it has strict forever wild conservation easements on each property to protect the land in perpetuity. So obvious kind of co-benefits we'll talk about there. They are more complicated nature-based projects than technology ones. And I would say both, frankly, in good ways and in more challenging ways. And on the good side of the complexity, I think much of that is around the wealth of the co-benefits, the biodiversity protection, drinking water protection, often amazing recreational benefits for local communities. And I think it's clear that many buyers and many of their stakeholders really value those co-benefits highly. On the challenging side, permanence of the nature-based credits is less certain than with technology-based credits. It's more of an issue for natural systems that are at risk for fires, for pests or disease, or outside of North America, illegal harvesting. Quantification, also more challenging for nature-based projects. And much of that is because of the need for, in most cases, a hypothetical baseline to determine the number of credits generated from project activities. And so you use statistically robust plots. They're set up in the project area, and they're measured before the project starts, and then regularly as required by the protocol. That's in contrast with, say, our methane reduction projects, where key parameters are measured and recorded every 15 minutes. So really, because of the differences, and I think in particular, the different benefits of nature-based and technology-based projects, as an investor that's invested in over 40 projects, we really like to have a mix of both types of projects in our portfolio.
Thanks, David and Dominic, for those insights on the different technologies and types of projects that we see in credits and the complexity that goes into evaluating their impacts. And with this context, let's now shift gears towards the usage of credits. Our first question on this is for Nicole. So with the recent increased scrutiny around businesses' net zero and carbon neutrality claims, can carbon credits still play a role in enabling companies to reach targets and make credible claims?
Yeah, so I'll start with maybe some context around the increased scrutiny. So I think we've seen a lot of headlines lately between Guardian articles. Delta was sued for their use of credits. There's been guidance out of Europe around not being able to be carbon neutral through the use of carbon credits. There's been updated versions of the green guides. So there's a lot of swirl right now around making claims, as well as the appropriate language to use when doing so. And it can be confusing for all parties, but customers and the general public are being increasingly more scrutinizing and asking questions. And on some level, that's an exciting time in the space, right? Where these are real news topics. But I'd say that it's largely impossible in today's world with current technology to reach net zero or carbon neutral without the use of carbon credits. They play a really essential role in being able to take climate action while simultaneously planning for direct decarbonization. So I don't think it's an either or where you're looking at, can I just keep investing in credits and not do anything? I think it's really important to do both and to pursue direct action, but direct action, both for your operations and within your supply chain, it takes a lot of planning. It can take capital and resources, and in some cases, technologies or fuel types that aren't readily available today. So I do believe strongly that it's important to invest in quality projects and pursue the right carbon credits for your goals while simultaneously working on those direct decarbonization efforts. But carbon credits really do play an essential role in enabling companies to reach their targets and even begin setting targets and making progress on their goals while doing that more long-term decarbonization strategy.
Thanks, Nicole. So on this topic of targets and claims, lately there's been an increased focus on measuring and reducing Scope 3 emissions, particularly from businesses where the majority of their emissions are generated in the supply chain. Can you explain the concept of insetting and how it might work in tandem with offsetting?
Yeah, absolutely. So as you noted, measuring Scope 3 emissions can be really complicated depending on the nature of your business, the level of data that's readily available, how engaged you are with your suppliers and what measurements your suppliers are doing. But the concept of insetting is basically investing in reductions that are directly in your value chain. So it might look like investing in a fuel switching project with one of your suppliers, or doing a reforestation project within one of your supplier communities. So it's actually it's similar to offsetting, but you're doing it directly within your value chain. It's still crucially important to accurately measure a baseline and measure the impacts of your insetting efforts. And I would say, in terms of how it might work in tandem with offsetting, like it very much shouldn't be an either or. Like insetting and offsetting are both really valuable tools. And I would say, offsetting is a more, I think, readily available opportunity to be able to just directly buy carbon credits, whereas insetting and kicking off a project within your value chain and aligning the right stakeholders, securing the funding to do that insetting, that can be a longer planning cycle, and it's a different level of effort, I would say. So it's a really valuable tool. It's a really important emerging kind of concept in the space, especially as we seek to more rigorously monitor and measure our Scope 3 emissions and simultaneously reduce them. So I think we'll see, more to come on insetting, but I would just very much emphasize that it's something that you can do very much in tandem with your offsetting efforts.
Thanks, Nicole, for sharing these insights about how the use of credits can play into businesses' decarbonization strategies. Our next section will be discussing the actual purchase of these credits. For businesses that are planning to utilize carbon offsets as part of their decarbonization strategy, David, what preparation should buyers undergo before approaching sellers?
Yeah, I guess I'd start with probably 3 core points. Really a good sense of how many credits you want to buy, and then over how many years, and what your budget is then for how much money you want to put towards this initiative. Then I think it's really important to understand what attributes associated with the credits and with the projects are important to your firm and your most important stakeholders. I mean, they're ones like location. Are you looking for more removals or avoidance credits, nature or technology based, which we've talked about here? Specific project types, like the grasslands resonate with you and with your stakeholders, or do methane reduction projects on farms as examples. And then those co-benefits. I'm going to take an example of just one of our projects. We have a forestry project on recreation land in the Metro Cleveland area. So of interest, certainly for firms with a strong presence in Ohio, and there are attributes that, some people really look for and others don't. So location, biodiversity protection, community recreation. So really just one example. I also suggest researching the seller and looking at the projects listed on their website. Are they geographically where there's interest for you? Are the project types of interest for you? And then when you look at that website and you find some projects that hopefully are of interest, then starting some of that initial due diligence that I talked about earlier. And wrapped, I would say, all around that really is an understanding around the risks your organization is willing to accept when you purchase credits, and which ones you prefer not to have, and or to stay with the seller.
Thanks, David. So pricing clearly is an important factor for both buyers and sellers. So let's dive deeper into this. In a market where pricing is down, but also inconsistent across technologies and credit types, how can buyers assess pricing? With a fixed budget, is it still feasible to get access to meaningful projects? Dominic, we'd love to hear your insights on this.
Yeah, those are 2 really great questions. And I think, once you've gotten through a lot of what David had said in terms of figuring out what you want to do, the obvious next question is, okay, well, how do I assess the pricing of now what I need to go and purchase, or what I would like to go and purchase, which I think the running theme across a lot of what we're talking about is informational gaps and doing diligence. And so it becomes really tricky in a voluntary market that's not regulated, and information is difficult to come by if you're not regularly involved in that market. And what I would probably suggest is that in a lot of cases and scenarios where the purchaser or buyer of credits is really entering the market once twice or very infrequently during the course of a year, it's likely not their entire job, 255 business days a year, to be involved in the voluntary carbon markets. What I might suggest is to work with intermediaries and firms like ours that have a lot of partners like David that we work with and are really involved in the voluntary carbon market on a regular basis, and have a depth of context to hear and see transactions that are actually happening and at what price, and see the bids from people who are looking to purchase, the offers from people who are looking to sell, and can get a lot of visibility to that you don't have if you're not involved in it on a regular basis. And so in a market that doesn't have indices reported, that doesn't have required reporting of transactions, there can really be a void of pricing information if you don't have line of sight to what's actually transacting. You don't have good partners. So one thing I often ask people who have purchased before is, and clients of ours is, well, how do you know you got good value for what you purchased? And it sounds like a simple question on the surface, but really, and I think it's something that a buyer really should be able to articulate, but becomes really difficult if you think about the opacity of this market. And so what I would say is that the partners you're working with and should help you be able to clearly explain and articulate why you got good value, but also why they've presented you with the projects they've presented you with instead of other projects. And if you don't have that, then I would say maybe try to find a firm or an intermediary that can help you with those things to assess your pricing. If you go to the next slide, also, the second part of your question is with a fixed budget, is it still feasible to get access to meaningful projects? I really feel that no matter what your budget is, you should always be able to get access to meaningful projects, particularly in this market environment. If you look at this graph, where we can clearly see that prices across all project types have dropped to some of the lowest levels we've seen in years. This should allow for budget conscious buyers to have opportunities that weren't really available before. But really, you should have access to quality and meaningful projects at whatever your fixed budget is. And we work really hard with our partners, like Inlansis and any number of project developer partners and investor partners that we have, to make sure that the availability of projects for both large wholesale volumes and smaller economies of scale are available. We also would say that just like any good risk management program, a portfolio approach is really prudent to offsetting, and it allows for affecting different geographies with different technologies while supporting different carbon reduction projects. And I think David mentioned this as well, but again, we work really hard to have that available across the entire spectrum of what your fixed budget may be. And I really truly think that it should be available no matter what your budget is. And if you want to talk further about it, we'd love to.
Thanks, Dominic. So in addition to pricing, lately there's been some heightened concern about the durability of credits. So for example, a wildfire can place a forest management project at risk. So what can you tell us about developments regarding carbon credit insurance?
Yeah, these durability concerns have obviously gotten a lot of scrutiny and a lot of attention recently. And the insurance market is one in which I think there's a need that's cropped up, or an issue that's cropped up in the voluntary carbon market space, and so people have moved to try to fill that gap. Quite assuredly, we can say that insurance can instill confidence and reduce risk in carbon credit transactions. I think as you look at them, there's a number of insurance providers that are cropping up, along with some larger institutional sellers offering some versions of what I would probably call self-insurance, to try to fill that need, as there is confidence has taken some hits recently with some of the scrutiny. But conceptually, it's still pretty new. And there are some value proposition questions that you probably need to ask yourself. But conceptually, it's pretty new, and details have yet to be seen, at least for me. That I have some questions about that are probably worth asking generally in the industry, right? In terms of, okay, if there's a proprietary pool of credits that is going to backfill, like what credits am I actually getting? How do I evaluate what is a suitable replacement for something that may have a reversal, like a forest fire that you mentioned, Tori? What are you actually insuring against, and what qualifies? Reversals from natural disaster, sovereign risk, moral hazard because some landowner decides, well, I didn't get what I thought, so I'm going to start cutting down these trees. Like, does that qualify for coverage? What about new data or technology somewhere down the line that now shows that a project is overcredited, and they've reduced the number of credits available or that have been credited? Time will really tell how effective this market becomes and how that shakes out, both from a legal standpoint and a documentation standpoint and from a cost standpoint. So I think it's a new wrinkle to solutions that are entering the market, an important one to instill confidence, but we'll see how it shakes out.
Thanks, Dominic. David, with your perspective on the project development side, are there other tools besides insurance?
Yeah, I'll dig into that. I think maybe just starting, Tori, on insurance, just giving our initial perspective. We've explored some of the offerings. To date, we felt like the risk reduction hasn't justified the premiums. And I think part of that is frankly because we're an investment fund. So we have a deep and diversified portfolio of credits, have a lot of experience in the space. So I don't want our view necessarily to be the one that others in the space adopt for a particular reason. And as importantly, it's a really dynamic market. So there are new insurance policies emerging. We are keeping an eye on them. I think there's a bigger picture when it comes to insurance and climate change, just from a kind of temporal perspective, where climate change, multi-decade problem, and insurance policies are generally just for a year. So then, the insurance company can change the policies. That's not a great fit. In thinking about other tools, I'd go back to the question of what risks are you trying to mitigate and minimize? Because I think there are some risks that insurance is really good at. Sovereign risk is an obvious one. I think ones like reputational risk from bad press, hard for me to see how insurance would cover that. So, in terms of alternatives and the risks you're kind of thinking about, I go back to Nicole's list of the key criteria and how those could be addressed. I'd start with just really solid due diligence that you or others conduct on what you view as the highest risks. And the highest risk for your organization, not just broadly, then I'd want to understand how the protocols for the projects you're looking at address those risks, because there's a lot of thought putting in by the standard agencies, the standard setting agencies, the registries, on ownership of credits, ownership of the underlying asset, buffer pools. And then I would certainly think about, when you contract with a seller, which risks you're willing to take and which risks you want them to take. And, that's in the context of, frankly, they should know the project a lot better than you do. So there are a lot of risks they should take versus ones that you as the buyer should take. It's also no good really having a seller accept the risks if they go bankrupt. So there are, additional protections if you have a counterparty with a deep balance sheet and lots of experience in these markets.
Thanks, David and Dominic, for sharing these insights about purchasing considerations for carbon credits. And before we move on to the Q&A section, I've got one last question for all of our panelists. Despite current pricing and uncertainty in the market, are you optimistic about the state of the voluntary carbon market, and why or why not? Nicole, would you like to start us off on this one?
Yeah, sure. So I am super optimistic about the state of the current market and just the amount of new participants in the market, as well as new and emerging technologies, and I would say like a doubling down on co-benefits, right? We're starting to see more efforts around biodiversity overlapping with carbon credits. And So just generally, like the amount of new protocols emerging, as well as just new interest in people setting targets and wanting to use carbon credits as a tool to reach those targets. Like I'm very optimistic about the market.
Thanks, Nicole. Dominic, how about you?
Yeah, just like Nicole, I'm really optimistic about where we're headed. I mean, while it's imperfect and I think there are things that have come under scrutiny, this is the best shared economy solution we have. And all the market participants I know are leaning in to foster a market of continuous improvement. And it's encouraging to see and hear all the collaborative work getting done to address concerns, to advance new technologies and innovate to make things better. And provide more transparency and diligence for all the market participants. I think, in a space where market participants like Inlandsys and Carbon Better clearly realize that it takes all parties coming together collaboratively to scale the market and effectuate change in the way we're all looking to try to do. I'm really optimistic that we're all moving forward together and heading towards something better.
Awesome. Thanks, Dominic. And David?
Yeah, I think just echoing what they said around innovation and just how dynamic this market is. I mean, we originated in compliance cap and trade markets, which have some benefits, but they just don't move. They don't innovate. They're not nearly as entrepreneurial as a voluntary market. So we're very excited about that. And I'd also say, we completed the raise for our second fund 2 weeks ago. So we're committed to putting tens and tens of millions of dollars into this market. So I think that's kind of the definition of not just optimism, but commitment to that optimism.
Thanks, all. It's nice to hear about the general optimism there is for the market, despite the concerns and uncertainty that we've seen and kind of chatted about today. So we'll now open it up to audience Q&A. If you haven't already, feel free to ask any questions you have by using the questions button on the bottom right-hand side of your screen. Our first question comes from Andrea asking, can you provide an example of projects for each type of credit? I believe this question popped up when we were discussing removals and avoidance credits. David, would you like to take this one and share about some different types of projects under each of those categories?
Sure. Yeah, happy to start on that. I think on removals, really getting back to that point of innovation, biochar projects are a new one that's out there. Direct air capture and other types of projects that are capturing atmospheric carbon are all by definition removal projects. Nature-based projects, as the trees grow, they capture carbon from the atmosphere, also removal on that side. And then on the avoidance side, methane projects, like we have a portfolio of projects on dairy farms that turn manure into methane and then destroy that methane. Also projects like avoided conversion of grasslands and forestry projects have significant avoidance offsets associated with them.
I'd maybe chime in with one other angle on removals, and there's a lot of attention going towards our oceans for carbon dioxide removal, so things like kelp sinking and the like.
Thanks, David and Nicole. Our next question from Adam is about this graph that we mentioned earlier. So Dominic, does this pricing graph show dollars per metric ton of CO2 equivalent, or are the units different?
No, that's exactly right. It's dollars per metric ton of CO2 equivalent. Yep.
Thanks, Dominic. And another question is from Robert. Is it known for carbon reductions to be recognized for inorganic usage of electricity during super off-peak hours or minutes? That is, opportunistically taking electricity when the only generators that can respond to the demand is the wind or other renewable generators. I'll hand this over to Nicole, but if someone else wants to chime in, feel free to do as well.
I was maybe going to volunteer Dominic. I think so. With respect to energy, we're talking about scope 2 emissions reductions from your electricity consumption. In terms of, carbon accounting versus a credit for this, I think you'd have to really look at the protocols and whether that's something that whether that reduction itself would enable generation of a carbon credit, or, oftentimes a mechanism in the scope 2 space would be renewable energy certificates. So I know that's like a kind of a generic answer, but Dominic, do you want to maybe chime in?
Yeah,
if you have anything to
I would
build on that?
probably no, I would probably just echo what you were saying. I think to me it would be a little bit questionable. I'm not 100% sure. My initial gut reaction is no, but I'm not. I would need to read the protocols around renewable power generation. I think it's more specifically around the actual generation activity and not maybe shaping your load and doing things that way, Robert. But again, it's probably worth a deeper dive into the protocols specifically around renewable power generation.
Yeah, the one other consideration around that would be the data itself, right? In terms of tracking that load, are you able to track it on an hourly basis and it's real-time data, or is this kind of over an annualized period?
Thanks both. Our next question from Adrian is on the topic of insuring carbon credits. Where would you say the biggest uncertainty lies between the pre-issuance risk versus the post-issuance risk of the credit? Hand that over to Dominic or David, if either of you wants to take that one.
I'd probably punt that to you, David. I think you probably deal with the pre-issuance risk significantly more than we do.
Yeah, happy to take that one on, and then as others want to contribute. I mean, I think those risks are very different, and they're much higher on the pre-issuance side. Really, if they have an issue, then do you know whether they actually can deliver? Are they going to deliver on time? Is it the expected volume? Pre-issuance, depending on the project type, you're certainly dealing with development risks. You may be dealing with permitting risks, other regulatory risks, construction risks, and during COVID, all sorts of delays, obviously, suppliers actually getting equipment. So it's all of that. And then starting up the project, what's the ramp up time? And, a host of kind of other early risks. And then you get into the more project operating risks around how well is that project operating? Is the carbon data management, which I mentioned earlier, robust enough to meet that third-party verification and validation? And what's the timing for all of this? Because there's understandably an optimism around when projects will deliver by those people putting them together. So, I think there's far more uncertainty pre-issuance than there is post-issuance. Post-issuance, someone has the credits and you have the ability to procure them and have them in your accounts instantaneously. And then it's what are those residual risks still around those credits that you may face. And certainly Nicole brought up a number of those related to the criteria she mentioned.
I think the only thing I would add to that, right, is when we're talking about carbon project development, it's not like other project development where you've got, if you're building a building, there's an EPC contract for somebody who's going to guarantee that it can get done in a particular way. So those pre-issuance risks are very different when you're talking about a carbon project versus like I'm building a building project finance issue. So like David said, they're really complex and difficult to maneuver and maybe not quite as easy to insure when we're talking about some of those things.
And just, I guess, doubling down on the complexity on the pre-issuance side, there's the actual development of the project, like boots on the ground, getting the project built and sequestering or avoiding carbon. But then there's also navigating getting the credit issued through the registry process. And that's something that we have seen kind of increased timelines for, while, registries are currently, they're seeing an influx of more projects, which is awesome. They're also simultaneously understaffed in some cases. And it can be hard to secure third-party verifiers to show up on site, things like that. So it's kind of like two lanes that you're considering with that project development side of just the actual project, as well as getting the credit issued.
Thanks all. We still have a few more minutes, so if anyone has any more questions, we can wait a little bit and see if anyone wants to ask them. And in the meantime, feel free to use that QR code to subscribe to Carbon Better's Sustainable Progress newsletter. All right, if there are no more questions, then thanks everyone for attending today's webinar. As mentioned, this session was recorded and will be available soon for sharing and replay. Thanks again, and we look forward to seeing you at our next event.
Thanks, y'all.
Thanks, everybody.
Thank you. Great. Bye-bye.